Ivan, you were one of the first Freddie Mac small balance loan program lenders out there, but you're making an even bigger push into the space now. What is it about where we are in the market today that's really motivating you to move even further in?
Well, Sam, as you know, Arbor has spent well over a decade focusing on small balance loans and affordable products and workforce housing. And the phenomenon we're seeing post-recession is that home ownership is at historical lows. And therefore, the multifamily market itself is growing and is larger. And the demand for multifamily housing is stronger. I think the phenomenon that we're facing is that not only is the market larger, but it's especially larger on small balance loans, and it's an underserved market. And it's also a market that's fragmented, aside from being underserved, and it's difficult to serve given the small balance of the loans and the efficiency that's needed in order to make it economically viable for a lender to participate. We have the expertise, we have the background, we have the automation, we understand the customer to really have an impact in a very, very significant way to make this process appropriate for the prospective borrower. So we're applying decades of experience, not only from our multifamily lending experience, but also the decades of experience we have on the residential lending side. And I do agree with Stephen that this is not a commodity, but yet we have to bring some commodity-like aspects to make this process more affordable and more commodity-like, but still keep the unique aspects of underwriting these particular assets in human hands.
When we look at the chart that's up on the screen now, rentership rate, which has been climbing so consistently since the beginnings of the housing downturn, and it has now climbed to the highest levels that we've seen since the mid-1980s. What's driving this? How much of this is demographics? How much of it is a reaction to the housing collapse? What do you see happening over the next couple of years?
I think it's a combination. Clearly, post-recession, nobody wanted to buy a home, and the people who were in a home lost their credit and couldn't be in a home. So renting was the next viable option, and probably the only option and opportunity. So by its very nature of what happened in the housing crisis, the rental market became the dominant part of the market.
The in terms of where we're then seeing us move in the macroeconomic environment, how that affects demand. Tell us a little bit about the employment picture.
So I want to get to the employment picture in a second, but the other aspect of the demographics are that millennials, people getting married later, household formation, people moving into more urban areas, that has really accelerated the demand for rentals. So generally, people who get married later, they don't buy homes. They don't form households. Now, that may change. People used to get married maybe in the mid to later 20s, have children in their late 20s. We think that's all got pushed back 5 years. So the whole household formation and need for homes has been pushed back, which created huge demand on rental housing.
Now, it's not just millennials. I think when we look at the distribution here, that we've got a bit of a barbell in the demographics. Are you seeing demand from the other side of this where we have empty nesters?
I think we are seeing a lot of empty nesters are selling their home. No reason to have a home, so they're renting. So not only do you have the millennials and late household formation, but you also have the empty nester phenomenon as well.
How has what we've seen happen in the market with regard to sort of relatively weak job creation trends until now, obviously some challenges with regard to the way in which household wages are growing, has that impacted the kind of housing that we want to bring to the market in the multifamily space?
So I think that's pretty interesting, and it really impacts the small balance loans. A lot of the new housing or multifamily housing that's being created is on the high end. And I think that you'll find on the small balance loans, which fits into this picture very well, people are buying, the 5 to 50 units, they're renovating them, they're bringing them online, and they're able to take those smaller buildings and really cater to small families or people living together, create what I call micro apartments, and customize those smaller buildings, and those smaller buildings are fitting this demographic formation.
Now, if I'm an investor in the market and I'm hearing a lot of chatter around the growth in the multifamily supply, the number of units that we've got under construction, there's some big national numbers. It sounds like the trajectory is a little bit different for relatively smaller properties.
I think it is. I think, as Stephen mentioned, a lot of it is workforce housing. It's meeting a certain demographic need which is underserved, and the people who are buying these understand the local markets, and I think that aspect of these smaller units will continue to thrive as it can be adjusted and meet the demands of the market.
One of the challenges that we've seen in the market has been a relatively slow wage growth as compared to what's happened with rents nationally, and you've talked about this already. In the over the next couple of years, if I'm an investor or developer, I'm thinking of repositioning a smaller multifamily asset. What's the direction? What's the trajectory of rent growth?
I think clearly wage growth has trailed rent growth significantly over the last 5 years, and there has to be some kind of catch-up. So either you're going to have a flattening of rent growth as wages catch up, or you're going to take some of these smaller buildings, which can be customized and create more utility and efficiency. We ourselves have been involved in many projects that are called micro apartments, and they're creating greater yield. So instead of a 2-bedroom, it's a 3-bedroom, or a 3-bedroom, it's a 4-bedroom. So they're getting more rent per square foot, but on a gross basis, they're servicing their market better, and it's more affordable. They don't have as much room space, but they're getting more yield out of those buildings in particular.
And how do the mix of households look different for that relatively smaller property as compared to the big building? Not only the households that are the target renters, but maybe even just the mix of amenities in the properties.
I think in the bigger buildings, you generally have bigger amenities, and these smaller buildings are more customized. They're more family-oriented, and people feel more homey. They're almost like their own home. There's a relationship with their landlord, and I think people tend to stay in these units longer than they do in the bigger buildings.
One of the things that you pioneered in order to address the needs of the market has been something called Arbor Loan Express. Tell us a little bit about how